Let's bring in somebody who has lived it, studies it, and knows more about it than almost everybody out there on the planet. That is Paul McCulley, formerly of Pimco, now of Georgetown University. And Paul, without getting too much into the Federal Reserve Act, Section 13.3, which basically is this jump ball, gives the Fed sort of semi-unlimited powers. In your view, did the Federal Reserve today, if credit controls equities and junk controls credit, today, in a way, did the Federal Reserve bail out the U.S. stock market?
The short answer is yes. The longer answer is it's not just the Fed. What the Fed's doing is very much in concert with what Treasury and Congress are doing. So I would say the Bank of Uncle Sam, we the people, our government, essentially ensured that our economy is a going concern, even though it's shut down. And believe me, I'll be the first to give a salute and a high five to the Fed. But I think it's important to recognize that this is a joint venture with Treasury and the Congress, because Congress has got to allocate the loss-absorbing capital for all of these SPVs that the Fed is creating, which then they can lever 10 to 1 with helicopter money. So it's a beautiful corporate cooperation between the fiscal and monetary authorities, and the stock market thinks it's really cool, and I do too.
Okay, SPV, special purpose vehicle, one of these other three-letter acronyms we haven't heard in 13 years. Now they're coming back, Paul. Let me ask it more directly. Do you believe that the taxpayer, because we forget that TARP, the taxpayer made money on TARP. Do you believe that these programs, while spectacularly expensive now, will all or some ultimately pay for themselves?
I think that will be the case in some of the facilities, and others it won't be. In fact, the one that I'm focused on the most is the PPP liquidity facility, which is the Paycheck Protection Program facility. And the Fed essentially said that they would take those loans originated by banks at face value as collateral into the special purpose vehicle. And we know categorically Congress plans to forgive those loans. So essentially that's one where the Fed will get losses, but they actually won't be the Fed losses. They will be absorbed by the Treasury. So this is very different than the financial crisis, where actually the Fed did make money. But this one is designed to, quote unquote, lose money on the PPP facility, and that money is come from Congress. And if they need more, I will bet my last dollar Congress will appropriate more. The PPP is the essence of getting the economy going forward as a going concern and stop the cascading of bankruptcies that would happen in the absence of these programs.
Yeah, because the PPP, again, for our viewers, and it's hard to keep track of, is designed more for the small and medium-sized business. It's that bank loans program that we have been talking about a lot. And, of course, separately, you've got all these backstops on bonds. I felt like today, and I don't know if this is needed or not, Paul, I have been critical of certain ETFs for about a year now in terms of market structure and liquidity concerns. Does the ETF have the liquidity to match the underlying assets? Whatever. Did we get kind of a bailout of certain ETFs and ETF providers as well today, too, in your mind?
There's no question that this thing's got moral hazard all over it, because it is a very macro program, and there will be beneficiaries of it that we were to sit down and say, should they be beneficiaries? The answer would be no. So I think that will be an outcome. But the bottom line is they had to go macro, and they did.
And you like it. Paul McCulley, we appreciate having you on the program. We hope you have a great long weekend, Paul. We'll talk to you again soon. Thank you very much for your insight. Very valuable at a time like right now. You take care, my friend. All right, Tim, I want to go back to you. I mean, this is something we've talked about for a long time as far as concerns about certain liquidities here. In your view, did parts of the ETF market and maybe ETF providers get a bailout today?
Well, I mean, by the way, love the professor, Paul McCulley, who was my economist at UBS back in the day. Look, I think if you look at what's going on in some of the ETFs, some of the asset classes, especially with asset backs and mortgage backs, and we'd heard about some of the large mutual fund companies. I don't need to name them, but they are household names that actually had some liquidity issues in a couple of their funds. I don't think the Fed is focused on that. Again, I think the Fed is more focused on credit, on the underlying credit, on the underlying things that make up those ETFs. And therefore, I think the run on liquidity for a fund provider is very different than the run of liquidity for the underlying names, in my view, even though ultimately the funds are the ones that are puking. They have to meet redemptions, and then therefore they have to puke out a bunch of these securities where there is no bid. But again, to me, the most important thing, or the most dominant thing that happened today was the Fed stepping down into junk and saying that they would actually be buying downgraded corporates and being willing to take them out. And that relieves so much stress on the system. We'd already seen a fair amount of thaw in the high-grade market, but taking this out of the high-yield market, even the specter of this, is what I think the Fed is focused on. And again, the Fed, with their words, said forcefully and creatively and whatever other adverbs we used. Those were the things that came to me from the Fed's statement today around what they did.
Yeah, and what they did is they front run some of these credit rating agencies. To Tim's point, what he's saying is that when we see this spate of downgrades of credit rating over the next couple of weeks and months, the Fed says, we got your back, junk bond market. Tim, great points there as usual.